Welcome to the Opening Bell Report.
It's that specific sinking feeling in your stomach when you look at a stock chart.
Oh, I know the one.
You know exactly the one I'm talking about. You're looking at NVIDIA today or maybe Palantir, and you see the price, and then you remember so vividly where it was 6 months ago.
The infamous if-only moment.
Yeah.
It is the universal language of regret in the market.
Exactly. If only I'd bought NVIDIA at $100. If only I'd grabbed Palantir back when it was sitting at $7 and, nobody wanted it. It's that painful pinch of FOMO, the fear of missing out. It haunts us. And we tell ourselves, okay, next time I'll spot it. I won't be afraid.
But here's the fascinating thing about those if-only moments. When you look back, it seems so obvious. But when you are actually living through them, in real time,
oh, it's never obvious.
they almost never look like golden opportunities.
No, usually they look like disasters.
They look like burning buildings. They look like money pits. And that is exactly where we are staring today. We are looking at a company that is currently screaming danger to half the market. Well, the other half, the very, very quiet half, is whispering that it might just be the trade of the decade.
And we are talking about Fermi Inc., ticker symbol FRMI.
That's the one.
And just to set the expectations here, because we have a lot of new listeners, this isn't a how to get rich quick deep dive. This is more of a how do we analyze a disaster deep dive.
Yeah, that's a good way to put it.
Because if you pull up the chart for FRMI right now, it is ugly. The stock is down 70% from its highs. Wall Street seems to absolutely hate it. There are lawsuits flying around. It's a bloodbath.
It is incredibly ugly. But that is the hook. That's why we're doing this.
Yeah.
Because despite the fact that everyone is screaming sell, and despite the stock crashing to around $10, we found something really strange in the analysis report. The analysts covering this company, the people whose entire job it is to dig into the books and the assets, they still have a price target of over $30.
That is a massive disconnect. Usually when a stock drops 70%, the analysts just,
They
capitulate, right?
Wow.
They downgrade it to match reality.
They do. But here, they are sticking to their guns, which creates this huge tension. Is Fermi Inc. a sinking ship, a bankruptcy trap that's going to zero?
Or is it this AI energy trade that nobody is talking about because they are too afraid to, catch a falling knife?
Exactly. So our mission today is to unpack that tension. We're going to look at the bear case, the crash, the lawsuits, the massive losses, and then we're going to look at the bull case, this contrarian math that suggests the market might be completely, totally wrong.
But before we get to the financial drama, we have to understand the product. Because the thesis here is actually, well, it's pretty simple. AI needs power.
It sounds simple, right? AI needs power. We hear it all the time. But I don't think people realize the physical scale we are talking about here.
Yeah, we're not talking about plugging in a few extra laptops.
No, not at all. We're looking at a physical wall. You have these massive AI models, ChatGPT, Gemini, Grok. We call them large language models. But physically, they're energy vacuums.
Okay, define that scale for us. Why is this so different from, say, the internet boom of the 90s?
Well, training these models requires thousands of specialized GPUs running at 100% capacity for months. And then once they're trained, every single time you ask ChatGPT a question that's called inference, it consumes way more electricity than the standard Google search.
I've seen stats saying a generative AI query uses, 10 times the power of a standard search? Is that about right?
Easily 10 times. Often more, depending on the complexity.
Yeah.
When you multiply that by billions of queries a day, you have a massive physics problem.
And the grid can't handle it.
The existing electrical grid in the U.S. simply cannot handle it. It's old, it's congested, and honestly, it's fragile. You cannot just plug a hyperscale data center into the grid anymore without waiting for years.
Okay, hold on. You used a word there, hyperscale. We hear that word thrown around a lot. For the listener who might not be in tech infrastructure, what exactly is a hyperscale data center?
Great question. So think of a normal data center like a big grocery store. It serves a local area, uses a decent amount of power. It's manageable. A hyperscale data center is like an entire industrial city.
A city.
We are talking about facilities that span millions of square feet and consume as much power as a mid-sized American city. These are what Amazon, Microsoft, and Google need to run their clouds.
And they can't just plug these cities into the regular grid because it's full.
Correct. The transmission lines literally can't carry the load. In many parts of the U.S., if you want to connect a facility of that size, the utility company will tell you, sure, we can hook you up in about 7 years.
7 years. In the AI race, 7 years is an eternity.
It's game over. So this is the bottleneck. You have trillions of dollars of AI chips waiting to be deployed, but nowhere to plug them in.
Enter Fermi Inc. So what is their solution? Are they just another solar company?
No, and that is the key differentiator here. If you are running an AI data center, you cannot rely on solar or wind alone.
Because the sun doesn't always shine and the wind doesn't always blow.
Exactly. Solar is intermittent. AI needs base load power. That means steady, 24/7, uninterrupted energy. You can't have your AI brain shut down just because it's a cloudy day.
So what's Fermi doing?
They aren't building solar farms. They're building grid-independent, nuclear-powered hyperscale campuses.
Grid-independent nuclear power? That sounds aggressive.
Yeah.
And probably really expensive.
It is. But the grid-independent part is the secret sauce. By generating their own nuclear power on site, they bypass the public utility grid entirely.
So no more waiting 7 years for the local utility.
Exactly. They don't have to wait. They just generate the power and feed it directly into the data center right next door.
So the analogy used in the analysis report is that they're the gas station for the AI revolution.
That's a good way to picture it. They aren't selling the Ferrari, that would be the NVIDIA chips. Yeah. They are selling the premium gasoline that makes the Ferrari run. And right now, they are trying to be the only station in town with an unlimited supply.
Okay, so on paper, this sounds amazing. You solved the biggest bottleneck in the biggest industry in the world. And back in October, the market agreed, right?
Oh, they loved it. Fermi had their IPO, their initial public offering, and the stock just went ballistic. It hit nearly $37 a share.
Wow.
It was the perfect narrative stock. You had AI, you had nuclear, you had growth. I mean, it was checking every single box for investors.
But narrative is one thing, execution is another. And this is where we have to pivot to the ugly part of the story, because we aren't at $37 anymore.
No, wait.
We're hovering around 10. That is a brutal crash. What happened?
Gravity kicked in, or more specifically, a reality check named Project Matador.
Project Matador. It sounds like a spy movie. What was it?
It was supposed to be their flagship deal, the proof of concept. This was the deal that was going to prove to the world that Fermi could actually sign a major tenant, a hyperscale tenant, for one of these campuses.
And the market priced the stock as if this deal was basically done.
Totally. They priced it for perfection.
And let me guess, it wasn't done.
It fell apart. The anchor tenant, who was never officially named in the report, but everyone assumes was a major tech giant, pulled out of negotiations.
Why? Do we have any idea why?
The details are murky, which is part of the problem. But when an anchor tenant pulls out of a massive project like this, it signals risk. Maybe they didn't trust the timeline, maybe they found a cheaper solution. Who knows? But the why almost didn't matter to the market.
The result was the only thing that mattered.
The deal collapsed. And in the world of speculative growth stocks, when your flagship deal collapses, the floor falls out from under you.
It was instantaneous, wasn't it?
Completely. Wall Street panicked. They didn't just sell, they dumped the stock. You have to remember, a lot of that buying at $37 was pure speculation. People were buying the story. When the story broke, they ran for the exits.
And when a stock crashes that hard that fast, the vultures start circling.
The lawyers.
Right. The analysis report mentions a pile of class action lawsuits accusing the company of misleading investors. Is this standard procedure?
It is, unfortunately, very standard in the U.S. markets. Whenever a stock drops that much on bad news, law firms will file these suits hoping for a settlement. It adds to the negative sentiment, but seasoned investors usually see it as noise.
Okay, but there is something here that isn't just noise. The financials. We have to talk about the earnings report. They reported a net loss of $346 million.
It's like a big number.
It's a huge number, $346 million. For a company that just lost its main customer, I mean, if I'm a listener holding this, that number terrifies me. How are they burning that much cash?
Yeah, that is a valid fear. But we have to contextualize it. This isn't a software company. This is heavy infrastructure. That $300 million isn't lost in the sense that it, disappeared. A lot of it is capital expenditures, CapEx.
Money spent on land, on permits.
Exactly. On engineering, on-site preparation. They are building the factory before they have the orders.
It's the field of dreams model. If you build it, they will come.
Precisely. But building nuclear-ready sites is incredibly capital-intensive. So they are bleeding money because they are building an asset that hasn't been turned on yet.
But that's the risk, isn't it? If they run out of money before they turn it on, it's game over.
That's it. That is the bankruptcy trap scenario. If they can't sign a tenant and they keep spending $300 million a quarter, they go to zero. No question.
Okay, so we've established why the stock is at $10. Failed deal, massive cash burn, lawsuits, panic. It makes sense. So why on earth are we even talking about this company? Why isn't this just a stay away warning?
Because of the math. And this brings us to the contrarian part of the deep dive.
The contrarian math. I love this.
Right. There is a fascinating section in the analysis report that looks at this crash differently. It distinguishes between the retail crowd, that's usually the general public, and the contrarian.
And the difference is how they react to pain.
Well, the typical retail behavior is to sell on bad news, to stop the pain. The news is bad, the chart is red, get me out. But the contrarian looks for bad pricing.
Okay.
They ask, okay, the news is terrible, but has the selling gone too far? Is the reaction worse than the actual reality?
And there was a specific moment in the market on a Friday recently that suggests the panic might be hitting a wall. Walk us through that, because it sounded like a bit of a detective story in the report.
This is really interesting if you watch price action. On that Friday, the bad news was fully out there. Everyone knew about the loss. The stock opened around $9.91. It started to dip, hitting $9.67.
So it was still crashing.
It was dropping.
Mm-hmm.
But then
Yeah.
it stopped. It didn't plummet to 5. It didn't go to 0. Buyers stepped in, big buyers. It bounced back and closed over $10.
So despite the massive loss in the lawsuits, people were stepping in to buy millions of shares at $10.
Exactly. The report calls this the someone knows something theory. When a stock refuses to go lower on objectively terrible news, it often means the smart money institutional investors, hedge funds, is starting to accumulate. They're looking past the current disaster.
They aren't looking at the lost deal. They're looking at the assets.
They are looking at the valuation cap.
Yeah.
And this is the part that really made me stop and think, let's look at those analyst targets again.
Unpack the math for us.
So the stock is trading around $10. But the consensus among the analysts who cover the stock, and remember, these are experts who value the land, the permits, all of it, their average price target is $30.67.
That is a huge gap. I mean, usually the price and the target are pretty close. This is a 300% difference.
It implies that the market is currently pricing in bankruptcy, while the analysts are pricing in a recovery. The report argues that this represents a 3x bagger. If the company survives, the stock doesn't just go up a little. It triples.
But that if is doing a lot of heavy lifting there. What does it take to bridge that gap?
No, that's the crazy part. They just need to sign one lease.
Just one.
That's the catalyst argument. The stock crashed because a tenant left. The theory is that if Fermi signs just one new major tenant, a Microsoft, a Google, an Amazon, the stock doesn't go to $12. It likely gaps up to $20 overnight.
Because it validates the model again. It proves Project Matador was just a stumble, not a death sentence.
Precisely. And think about the market cap. Fermi is valued at around $6 billion right now.
$6 billion sounds like a lot of money to me.
In the tech world. For a potential utility infrastructure monopoly, it's peanuts. If they succeed in becoming the gas station for AI, $6 billion is a rounding error. A traditional utility can be worth 50, 60, even 100 billion. The upside is mathematically huge if they execute.
But we have to play devil's advocate here. We have to be responsible. This isn't a sure thing. If they don't sign that deal,
Then the stock goes to $5 or lower.
So let's talk about the risk-reward ratio. This is a term traders use a lot. How does it apply here?
It's all about asymmetry. So let's estimate the downside. Let's say the bleeding continues, no new deal. The stock could drop to $5. That's a 50% loss from here.
Which is painful. Losing half your money is real risk.
It is, a lot. But look at the upside. If they sign a deal, the target is $30. That's a $20 gain per share. So you are risking $5 of downside to potentially make $20 of upside.
That's a 4-to-1 ratio.
Exactly. In the casino of Wall Street, those are incredible odds. It doesn't mean you will win. It just means that the payout justifies taking the risk. It's an asymmetric bet.
So the strategy mentioned in the report isn't sell your house and buy Fermi. It's nibbling.
Yes. Nibbling at $10. It means you take a position size that you can afford to lose. You treat it like an option ticket. You're paying $10 for a ticket to the future of AI energy. If the ticket expires worthless, you lost 10. If it hits, you make 30.
It's interesting because it reframes the narrative. Instead of looking at the past, the failed deal, you are betting on the macro future.
You're betting that AI simply needs this power, and eventually someone will have to pay for it.
Which brings up a good question. I mean, is there really no other alternative? Why go through the headache of nuclear if you don't have to?
That's a great point. Why not just cover Nevada in solar panels? It seems cheaper and safer. Two reasons. Density and reliability. We talked about reliability. The sun goes down. But density is the killer. The amount of land required to generate 1 gigawatt of power with solar is massive. Thousands and thousands of acres. A nuclear SMR, a small modular reactor, can do that on a fraction of the footprint.
And land near data centers is expensive.
Very. Plus, the regulatory moat. Do you know how hard it is to get a permit for a nuclear site in the U.S.?
I assume it's a nightmare.
It takes years, sometimes decades. Fermi has sites. They have permits. That is tangible value. Even if they don't have a tenant right this second, they own the rights to generate nuclear power. And that's what the value investors are likely looking at.
They see an asset selling for pennies on the dollar because of temporary panic.
That is the perfect summary. You are betting on the asset, not the current sentiment.
It really does feel like a movie script. You have the Icarus moment at the IPO, the crash, the villains in the lawsuits, and now we're in the second act, waiting to see if the hero can get back up.
And that is why the report calls it a show me story.
Yeah.
The market is effectively crossing its arms and saying, okay, Fermi, you have the land. You have the plans. Show me the money. Show me the signature on the dotted line.
And until they do, the stock is going to be volatile. It's going to whip around.
It will be a roller coaster. If you can't handle a 10% swing in a day, this is not the stock for you.
So let's wrap this up. Let's bring it all together for our listener. We've covered a lot of ground.
We have a company, Fermi Inc., solving a massive, undeniable problem, the AI energy crisis. The grid is full, AI is hungry, and nuclear is really the only dense baseload solution.
But the company is currently in the penalty box. They are plagued by a failed deal project Matador and a really scary financial report.
Right. A $346 million loss. The stock has crashed 70%, yet the professional analysts haven't budged on their $30 price targets.
Creating a setup where the downside is real, maybe $5, maybe even $0, but the upside is a potential triple or more.
It is the definition of a high-risk, high-reward contrarian play. It is not an investment for your retirement fund. It is a speculative trade for the aggressive part of your portfolio.
So the ultimate question we have to ask you listening right now is this. Is Fermi Inc. a scam or a steal? Is it a bankruptcy trap waiting to take your last $10, or is it a golden entry point that you'll be bragging about in 5 years?
And this raises a really important philosophical question to leave you with. Think about the nature of fear in the market. When everyone is terrified, when the headlines are all negative, is that usually the time to run away? Or is that the only time you can ever get a truly great price on a valuable asset?
If the grid really can't handle AI, and Fermi is one of the only companies building these nuclear campuses, does that one failed deal actually matter in the long run? Or is it just a temporary stumble in a necessary revolution?
It's a question of your timeline. In a month, it looks bad. In a decade, it might just look like a blip on the chart.
Something to mull over while you're charging your devices tonight and wondering where that power is actually coming from. Thanks for diving deep with us. We'll see you on the next one.
Don't forget to like, share, and subscribe for more.